There appears to be a consensus that within the energy industry that demands for immediately dropping oil and gas investments and leaving it on the ground are counterproductive, and that natural gas for the first time is really the best choice for the global energy transition to net zero. If anything, the last 18 months have highlighted the role of natural gas and the need for energy diversification. And here to share his outlook on the energy sector is the Secretary General of the International Energy Forum, Joseph McMonigle. Joseph, thank you for being with us this morning. We have to talk about oil prices. It's hit $90 for the first time in 2023. That's on the back of the OPEC plus cuts that's set to continue for the rest of the year. What's your outlook for the next 2 quarters?
Well, we've been saying for some time that we expect global inventories to start to have massive draws, and you're starting to see evidence of that even before this decision. And I think, there's kind of been a tale of two markets here. You have the commodities market, and there's a lot of skepticism about continued growth in demand, with China kind of being a big shadow over demand. I mean, the expectations was for a great turnaround in terms of from post-COVID times in terms of growth in China, but on the physical side of the market, it's quite tight. So it's sort of like the macro commodities market is factoring in fears of a global recession and economic data from China and try to translate that to demand scenarios that don't necessarily show up on the physical markets because they're quite tight. So I think what OPEC is doing, or OPEC Plus is doing through these voluntary cuts, remember it's not OPEC policy, it's voluntary cuts. They're trying to be proactive because of this still was perceived as a question mark in the macro market about the return of China. However, I have to say we see demand in China already at record levels. Yes, it's not back to where I think expectations were, but between China and India, you have almost 2 million barrels a day increase in demand in the second half of this year. And also you factor in the OPEC cuts from Saudi Arabia and Russia. Also in Iraq, the pipeline to Turkey has been shut since March, so that's affecting about 300,000 or 400,000 barrels a day. Also, Kuwait has a new refinery, so they're diverting exports to that refinery. So they're down about 500,000 barrels a day. So combined, all those countries, they're down about 4 million barrels a day from their individual peaks. And so you add that with this growth in demand in the second half of the year, and we're an extremely tight market. In terms of prices going above 90, I think it was the market had already priced in that Saudi Arabia and Russia would extend their cuts. But I think what was a surprise to the market was they would extend it through the end of this year. And so I think that was a surprise, and it popped, I think, oil prices above 90. We'll see where it goes because generally it settles down. But I would say that the OPEC statement or the Saudi statement, and I think the Russian statement also said this as well, that they would, renew it every month. So if something were to change in the markets, if prices were to spike above $100 or something, I'm sure there would be a review of the policy. And also they left open in the statement itself the option to potentially increase production as a remedy.
Gas prices leapt to an all-time high after Russia cut its supply to Europe. That caused Asian spot prices to spike. Are we seeing supply and storage side of things stabilize now?
Well, obviously, in places like Europe, where really the only storage exists, there really isn't significant storage in Asia. But Europe has been able to refill inventories. But I'm worried that there's some complacency setting in on the part of policymakers, particularly in Europe, because it wouldn't take much for a few weeks of cold weather to really deplete these inventories. And as we saw last year, this is not a situation that's confined to Europe. I mean, the high prices in Europe basically price other parts of the world out of the market. I think one phenomenon that we had last year that won't exist this year is because of the war in Ukraine and high prices in Europe, is you had some countries, even China, divert cargoes or resell cargoes to Europe and take advantage of the arbitrage. But that was at a time when Chinese demand and other Asian country demand had not returned to normal levels post-COVID. Now it's back. So I think you're not going to see cargoes that were contracted for Asia suddenly showing up in Europe. So it's going to be a little bit tougher, and it won't take much for us to have a repeat of last winter. And actually, it's not just this year, it's the next 2 or 3 years.
And the potential strikes at the Chevron plants in Australia, that's going to prove quite disruptive to North Asian markets, which most of them rely heavily on LNG supplies.
Yeah, I think what that shows us is, oil markets have always been a global market. Gas hasn't been viewed that way. But that example shows you that we are in a global gas market. And something affecting one part of the world is not confined to that part of the world, just like prices in Europe last year affected other parts of the world. In fact, some countries abandoned gas and switched to coal, which is a dirtier carbon-emitting fuel source. So it ended up being counterproductive in terms of our climate goals.
Okay. The IEF estimates that nearly $5 trillion of global upstream oil and gas investments is needed really by 2030 to prevent a future energy crisis, as you've put it. How far behind are we in these investments?
Well, we need to basically go from about $400 billion a year to about $600 billion on an annual basis. And essentially during COVID, because of the uncertainty around COVID, a lot of companies cut CapEx, including NOCs. Now, NOCs have come back to investing in new production capacity, but the IOCs and the smaller independents like U.S. Shale have not come back. And there's a lot of reasons for that. I mean, ESG and sustainable investing is one reason. But also these companies are in this new thing about capital discipline. They want to return a greater investment to shareholders. So there's a lot of reasons why this is happening. But the bottom line is what you referenced is we in order to meet current demand levels, because when you have fields, they deplete over time. So you have to keep investing just to keep the production flat, let alone address greater demand in Asia and parts of Africa. And so we need to invest more in hydrocarbons. It may seem odd for the head of an international energy organization to be talking about this, but I'm worried about our continued progress on climate and the transition. Because if prices get too high and the public starts to equate transition policies or action on climate with high prices, we're in big trouble. And we need to keep the public on board for what are really challenging things we'll be asking them to do to help us make progress on the transition. So it's really important we pay attention to these high prices and manage the transition.
Okay, Joseph, thank you very much for those insights. We've run out of time, I'm afraid.
Great to be with you.
Right. And that was Joseph McMonigle from the International Energy Forum.